Welcome to The Explainer. Now, as a financial advisor, I've got to admit I am naturally pretty skeptical whenever someone claims an algorithm can perfectly time the market. I mean, we've all heard the pitches, right? But today we're critically analyzing a really fascinating data experiment. What actually happens when you pay top dollar for a premium AI and ask it to predict something as wildly volatile as the crypto market? We're going to break down the output of Grok Heavy. This is a $300 a month AI tier, and it was recently fed a massive, highly complex prompt by creator Aaron Bennett, who basically asked it to forecast the ultimate market tops for Bitcoin, Ethereum, and the altcoins. But look, as an advisor, I don't just care about the flashy numbers. I care about the methodology, the risks, and the underlying data. Does a highly expensive algorithm actually give you an edge, or does it just manufacture a false sense of security?
Okay, let's dive into this. Here is our roadmap for today. 1. Grok AI's updated base case. 2. The 28% bear case. 3. Macro forces and tailwinds. 4. 5 indicators to watch. And finally, number 5, the final reality check. So, to really understand the output, we first have to understand the input. This whole analysis stems from a highly detailed prompt created by Aaron Bennett. He explicitly told Grok Heavy to act as a top-tier crypto analyst, and then he fed it a massive array of current macroeconomic variables. I'm talking details about the new Federal Reserve Chair, Kevin Warsh, the status of the Regulatory Clarity Act, ETF flows, and even the purchasing behavior of corporate whales like MicroStrategy. The goal here was to force the AI to process all of this real-world high-level data to update its market cycle predictions. It's a lot of data to chew on.
All right, let's start with Section 1, Grok AI's updated base case. Here is the exact data dump from Grok's base case. For Bitcoin, the AI predicts a peak date range between October 2026 and February 2027, with a price target sitting somewhere between $165,000 and $210,000. Pretty wide range. Now, Ethereum is projected to peak slightly later, between November 2026 and March 2027, reaching between $6,800 and $9,000. And then altcoins are expected to follow last. But you know what's really interesting about this? The confidence score. Despite processing literal mountains of data, the AI only gave itself a modest 5 out of 10 confidence score for its Bitcoin prediction, and an even lower 4 out of 10 for Ethereum and the altcoins. It specifically cited high uncertainty around the new Fed chair and overall macro volatility. So, even the AI isn't entirely sold on its own numbers.
To justify these future targets, the AI relies heavily on this concept of a mid-cycle reset. Basically, it views the recent high of $126,000 not as the end of the bull market, but merely as a temporary correction, a pit stop, if you will. And to back this up, Grok heavily references the MVRV ratio, which is a classic on-chain metric, noting it's currently sitting low at 1.4 to 1.5. That's well below the euphoric 3.5 to 5 levels we've seen at previous cycle tops. But here's where my advisor skepticism kicks in. Relying on MVRV right now might be incredibly misleading. We are in a totally new era dominated by massive Wall Street ETF inflows and corporate treasuries just hoarding Bitcoin. These entities do not behave like your traditional retail holders, meaning the way profit is held and realized on-chain has fundamentally changed. So if you're waiting around for a historical MVRV target of 4 or 5, you might completely miss the actual sentiment shift of this current, highly institutionalized market.
But what if the AI is wrong? Let's look at Section 2. The 28% bear case.
Anchor yourself to this specific metric. After crunching all of that data, the AI assigns exactly a 28% probability that the market cycle has already peaked. Now, sure, it's not the majority probability, but a nearly 1 in 3 chance of a prolonged downturn. That is a risk profile you simply cannot afford to ignore.
In this bearish scenario, the AI outlines a classic 70 to 80% drawdown from the highs. We're talking serious drops here. It predicts Bitcoin could bottom out between $48,000 and $62,000 by late 2026 or early 2027. Ethereum would plummet down to the $1,400 to $1,900 range. And what exactly would trigger this? Well, the AI points to very tangible real-world catalysts: tighter monetary policy under the new Fed chair, a stalling of regulatory progress in Congress, or renewed geopolitical shocks. It's a very sobering, data-driven reminder that markets, quite frankly, do not just go up in a straight line.
Let's move on to Section 3, Macro Forces and Tailwinds.
The AI essentially balanced structural tailwinds against macroeconomic headwinds. It's like a giant tug-of-war. On the bullish side, it noted the progress of the Regulatory Clarity Act, sustained demand from those ETF inflows, and the overall resilience of U.S. equities. But hey, the headwinds are incredibly real too. elevated inflation remains a very persistent threat. And get this, corporate giant MicroStrategy recently made its smallest weekly purchase of 2026, even hinting they might sell some holdings before year-end. Plus, crucially, new Fed Chair Kevin Warsh's upcoming policies introduce significant liquidity uncertainty. The AI is doing its best to weigh these massive, completely conflicting forces against each other.
Which brings us to Section 4, 5 indicators to watch. Grok recommends actively monitoring these 5 specific things over the next 90 days. We've got sustained Bitcoin ETF inflows of over $500 million a week, the MVRVZ score rising toward 2.5, Fed Chair Warsh's very first major FOMC comments, the full Senate vote timing on the Clarity Act, and MicroStrategy's weekly buying habits. Now, I have to strongly warn you about a few of these indicators. Things like ETF flows and corporate weekly purchases, they are highly reflective and incredibly prone to manipulation. They aren't pure leading indicators. They are herd-driven. Literally, one large institutional block trade can trigger a cascade of retail FOMO, creating this self-fulfilling momentum trap. Relying on them requires constant, exhausting vigilance, because the moment the big money quietly stops buying, well, these metrics will flip on you instantly.
All right, finally, Section 5, the final reality check.
And this brilliantly illustrates the core problem with the AI's forecasting. Take a look at this timeline. Back in November 2025, this exact same AI boldly predicted Bitcoin would peak on March 5th at $140,000. So what actually happened? Well, Bitcoin peaked early in October at $126,000, and then it suffered a massive correction. The AI was completely off the mark. So what did it do when Aaron queried it again in May 2026? It simply moved the goalposts. It pushed the new peak prediction out 7 to 11 months and actually raised the price target. It didn't admit defeat, it just recalculated a brand new, further out horizon.
Which brings us to the ultimate question. After seeing all this, should you actually trade on this AI's advice?
The creator of the prompt, Aaron Bennett, delivered a pretty stark and honest conclusion, and I quote, "I highly recommend not trading on the advice of Grok because it has been incredibly wrong every single time. It just keeps pushing the data out farther. Despite sifting through tons of data, on-chain metrics, and macro indicators, the AI ultimately behaves just like a flawed human analyst who refuses to admit the cycle might actually be over, choosing instead to just perpetually extend the timeline."
So, the absolutely crucial point is this. There is a profound danger in outsourcing your financial conviction to an algorithm, no matter how many hundreds of dollars it costs per month. Sure, AI can aggregate data, it can summarize macro conditions, and it can build really logical-sounding arguments, but it cannot manage your personal risk. It cannot feel the very real pain of a 50% drawdown. As an investor, is paying for an AI's manufactured confidence ever a real substitute for your own critical thinking and risk management? I'll leave you to ponder that one. Thanks for joining me on this explainer, and stay vigilant out there in the markets.